There's a well-known idea and concept expression, never lose money. How is it possible never to lose money? This is the answer. Watch the whole thing and you'll understand. There's a difference between a realized loss and an unrealized loss. A realized loss is person owns, let's say, shares of a company, and then the company, their stock goes down, the company goes down, and you panic and you sell. You think it's going to go down more and you sell. You think, why would I want to lose more? I'll only lose a little bit. It's called a realized loss. An unrealized loss is when a company goes down. For example, just recently, a couple weeks ago, actually, a lot of stocks went down because of the whole tariff business. And guess what? I'm sure a lot of people did. They sold and they panicked. We didn't. We didn't sell nothing because we realized it's an unrealized loss. And therefore, when everything went back, no problem. It's no issue. In fact, we gained because we bought more stock on sale when everything was cheaper. That's the difference between a realized loss and an unrealized loss. Person should never sell when something's down unless it's part of a bigger plan. Let's say, for example, tax loss harvesting. It's a strategy that's used when investors could use this to reduce capital gains taxes from selling profitable investments. In other words, let's say you have money divided in two areas. So one area gained a lot, and now you want to sell that. You want the gains. Whatever reason, you want another investment. However, you're gonna have to pay a lot of taxes. So if you sell something else at the same time in the same tax period that had a loss, you could now use that and you won't need to pay taxes on your gains. Called tax loss harvesting. You can look into it more. Right? It's got to be part of a bigger strategy if the person has a realized loss. Right? That's the idea over here. Real investing. Right? Unrealized losses, they can and will happen. Real investing is invested for the long run. Just look at the word investing. Investing means you put your energy into it. You believe in something. If you believe in something, you don't just sell just because it goes down. You believe in something, so now you do this, right? I believe in learning Torah. So I bought tens of thousands of dollars worth of this farm. It's an investment. It's my life investment. It's my life. Right? One day I was tired or sick, so I'm not able to learn. So now I'm going to sell all my farm. I'm going to sell everything that I have. That'd be ridiculous. It's the same thing. When a person goes into a company, that means that they believe in it. Stocks are for the long run. John or Jack Bogle, the founder of Vanguard, which I'm a big fan of, who I'm a big fan of, and Vanguard in general, I'm a big fan of. They say that people are in stock who he says that someone who's in the stock market for a short run, he might as well just go to a casino. Only someone who's in it for the long run is called a true investor. Smart investor realizes that stock becomes more risky, not less, as their prices rise, and less risky, not more, as their prices fall. Think about that for a minute, because most people think the opposite. When a stock price falls, it becomes less risky. When it goes up, it becomes riskier. And a lot of times you have companies that are overvalued tremendously. The smart investor, listen to this, dreads a bull market. In other words, a smart fellow realizes when stock prices are very high, that's not even a good thing. He doesn't even want them to be high. Why? Because now it costs more money to buy new stocks. Conversely, as long as the person keeps enough cash in his hand to take care of his regular spending needs, he should welcome a bear market. When the stocks go down, that's a time to put more chips on the table, put more money into it. That's what a smart investor wants. The prices are on sale, they're reduced. Rabbi Dr. Mester writes, spiritual pursuits are more important than the trappings of wealth. Having a frugal lifestyle applies even to doctors. Now, living rich doesn't mean that you're rich. A lot of people, they spend all of their money. They have no money. That's not real. That's not wealth. The short-term gyrations, movements of the stock markets, they're scary and irrational. But over a long period of time, the stock market is a very rational and usually very profitable place to be long term. When you buy stocks in a well-researched, fundamentally sound and growing company, that's a logical and a fairly safe thing to do. A portfolio, you carefully choose it, you diversify it, and then leave them alone to grow. Honestly, just get an index fund in the S&P 500. You're already diversed over there. That's the way. Just leave the thing. If you're constantly trading in and out of the market, for the overwhelming majority of people, that is neither wise or profitable, and not a particularly good way for an observant Jew to spend his time. It's a Meister plan on page 24. Dividends are crucial to long-term investing. A dividend in this every single quarter, there are 4 quarters in a year. You get from the certain stocks, you get a percentage of the stock. It comes right back at you, and then it gets reinvested in the stock. You get a percentage. So, for example, let's say the dividend yield of the stock VOO, which is an index fund of the S&P 500 that covers the top 500 companies in America, pretty much in the world, and you get a piece of all of the companies, right? One share is trading around, as of now, I think it was around 540, maybe a share. I remember when we were getting them, it was 300. Now it's double. Um, so it's 540, so it has a dividend yield of 1.5%. So that means that every single year for that stock, right? I'm getting $1.50 for every $100. Multiply that by 5, so you get $7.50. So you get roughly $8 a year for every 550. That's on top of the gains of the stock. So that's the dividend. So if a person buys, let's say, $100 worth of VOO, so they're getting $1.50 every single year from that. That's what that means. So when you have the long-term investing, you tap into those dividends. It has to be there for a duration of at least 3 months to accumulate the dividends. So when it's short-term, though, a person is lacking that. He's not going to have that because he's selling in and out. When you're selling in and out, you don't get the dividends. The best times to buy the stocks were yesterday. Second to best time is today, and the next best time is tomorrow. The period we live in is not important. The trick is you want to get in the market early and for the long term. That's the main priority. That's what's important. Meister plan, page 25. That's what it's about. The average people just buy an index fund, buy slowly over time a little bit. Nowadays, you could buy what's called a fractional share. You don't need to buy a full share, the whole 550 if it's too big of a commitment. Just buy fractional share. Just get in slowly after time. Everyone needs money eventually down the line, expenses, weddings, bar mitzvahs, whatever exactly it is. $10 a week could add up every single week, being consistent with wealth, even in the millions over time. Right? It's hands off, little worry. You could do automatic investing also. You don't even need to waste time going on the website. Not that it takes so much time, it's a couple minutes, but still. Right? When the market goes up, good news, because now your money grew more. When the market goes down, good news, because now you get more for your money on your invested dividends at a lower price. And also the new money going in the new stocks that you're buying are going to have the greatest profits decades later. All right. Now the warnings are you have to be patient. This is a get rich slow approach. Usually the get rich fast don't work. The optimal time frame for tremendous success is in the 30 to 40 range. Tremendous success. It's amazing what compound interest does. And the index fund, it yields on average around 9%. 9% is incredibly high over time. 30 to 40 years, you know what that does? Even in 10, 20 years, you could get a lot of reward. The main reward, aka the explosive exponential growth of the capital, occurs later years when the reinvested dividends, when the compound interest, when they're working together in a phenomenal fashion. Commitment. Don't commit to penny stocks for 1 second unless you're gonna hold them for, this is a good one. Don't commit to penny stocks for 10 minutes unless you're prepared to hold them for at least 10 years. You gotta invest in the long term. You gotta also be frugal. You have to live within your means and invest the saving for the future. Financial freedom is the sweetest thing you ever bought and one of the most wonderful things you could ever give to children. Don't be greedy. Historically, stocks have returned around 9, 10% annually, counting the reinvested dividends, doubling down on the money every 7 years. There's some occasions, like Coca-Cola, which returned around 15% since 1919, doubling your money every 5 years, but don't be greedy. Be grateful if you could get anywhere above 10% over many decades. Don't go for the risky, volatile investments if you don't understand, and that's gambling, that's not investing. Reinvest old dividends, pick good companies that have rising dividends for many decades. Reinvest every single penny of those dividends for additional fractional shares. The fortune from Coca-Cola that we just described would only be 1/10 of the amount if the dividends were not reinvested. Think about that for a moment. You gotta invest the dividends. That's the key. That's the idea over here. Put in the money in good times and bad times, no matter what, $10 a week. Once you get in the habit of investing small amounts and begin to see how it adds up, the habit's very hard to break, and you'll want to put in even more. You have to remain calm, concentrate, choose good companies. That's a rational thing. Ignore the stock market's fluctuations, which are irrational. The only rational thing about the movements of the market is that over the decades, the stock price of any good company will increase, and it will closely parallel the steady rise of the company's profits and dividends. Ignore short-term ups and downs of the market. They're usually meaningless and not based on true underlying economic reality of a company. A lot of times they're just based on emotions. When the market goes up, you're rewarded with growth of capital. When it goes down, you're rewarded with a low price for your new investments and reinvested dividends. Be happy. The short term, up or down, you win. It's win-win. In the long term, you pick good companies and leave them alone. They're they're just going to keep rising significantly. Hands off. Be happy, relaxed. Concentrate on things that are important in life instead. Put a little money in, keep putting it in, forget about it. Focus on things that are more important in life, learning Torah, spending time with family, performing other mitzvahs, good acts. This cannot be stressed enough. Ideally, start investing 13 or earlier, 20, and then ignore your investments until you're around 60, the earliest. The earlier you get in, the better. We're talking long-term financial planning. There's also long-term spiritual planning. Money could be budgeted for learning Torah. Time could be budgeted for learning Torah. In the end, everything is in the hands of Hashem's. However, we could still make reasonable plans. Otherwise, how will we go about our lives? When we own a stock, a good stock that we research and understand, we actually own a small piece of a business, of that business. Anything that we buy could crash tomorrow. But we have to believe that none of the companies will be less effective companies tomorrow, 5 or 10 years. And if you believe that, you go for it. You have to believe in decades of future growth from that company. If you buy something, it could drop. The price could go down. It could be half of what it's worth tomorrow. You never know what's going to happen. But if you're going to hold them for 10, 20, 30 years, you'll be rewarded. Listen to these amazing stats. If a person held on to his stocks for 7 years, there were only 5 times when he would have ever lost money from 1926 to 1991. This is a quote from the Meister Plan, who only analyzed those times because that's when the book was written. But I'm sure it applies today also. Crazy stats. If a person held on to stocks for 10 years or more, he would have never lost money once between 1926 and 1991. 65 years, never lost money once when held for 10 years or more. This includes the Great Depression in the 1930s and the terrible bear market in the early 1970s. These statistics assume that all of the dividends were reinvested. Stocks can and will go up and down. Drops of 20, 30%, that could happen. Drops of 50% or more, they're not unheard of. It could be catastrophic for a short-term investor, but for a long term, it's advantageous. You consistently put the same money every single week in, let's say $10 into a stock like Coke, and a share's Coke is selling for 20. Let's just say these are numbers. Obviously, the numbers are much higher nowadays. So then you could buy a share, half a share each week. But if the price will go down to $10 a share, then you bought a full share. The extra half a share per week adds up tremendously over the time. When the price eventually goes back up again, the shares that you bought cheaper, those are going to be your greatest profits. If you're constantly investing in small amounts week after week, then the market dips. That gives you opportunities to buy shares on sale. When the stocks go down, that's a time to buy more, not less. It's like getting 50% off your groceries week after week. The investment guru Philip Fisher said it's like buying dollar bills for 50 cents each. In short, never invest in stocks. If you need the money in 5 or less years. You could leave the money untouched between 5 and 10 years, your risk drops dramatically. Once you could put the money away for 10 years or more, then stocks become a very safe way to invest. Your chances of losing money are virtually out, and you're going to get more growth than any other investment vehicle can provide. That's the golden number, 10 years or more. Let's say, for example, and these are fascinating examples. Let's say someone was unlucky enough to buy stocks the day before the Great Depression, the great stock market crash of 1929. On paper, he would have lost 38% of his money by the next year. This would only be a real loss if he panicked and it was a realized loss and he sold out at the bottom. But if he held on to his stocks for another 10 years, that we've been saying the whole time, he would have had an annualized profit of 7.76%. almost 8%. Amazing. And if you would have held on just another 6 more years, 16 years total after the Great Depression, you would have had an annualized profit of 15%, 14.74%. Guess what? If you hold another 5 years, you would have had 14% also. Excuse me, if you would have held until 1959, is after the Great Depression, so 30 years after the Great Depression, you would have had every single year 14.09%, 14%. He would have doubled his money every 5 years for 30 years straight. This is after the Great Depression. And this assumes that it was just a one-time investment right before the stock market crash of 29. If you would have invested faithfully $10 per week during this time, the returns would be even higher because all along you're picking up cheaper shares. Think about that for a second. It's in the Meister plan, pages 85 to 86. Never ever buy stocks with money you need in 5 or less years. Even be cautious about buying stocks with money that you need in less than 10 years. But if you have a time frame of 10 years or more, quality stocks could be a very safe investment. And with longer frames, 20 or 30, 40 years, the risks drop dramatically. Warren Buffett said, don't own a stock for 10 seconds unless you plan to hold it for at least 10 years. Don't panic when stocks go down, like we said. This is a time to buy more quality stocks on sale. Warren Buffett said, don't own stocks unless you can stand to see the value of your investment go down at times by 50%. You have to be calm with that. Mr. Nathan Sachs, the president of the Mercantile Safe Deposit and Trust Company, he writes, this is in his introduction to the Meister plan, that individual investors tend to panic during market turbulence. They often buy at the top of the market, so to say, and sell at the worst time. Most people don't know the old saying, buy low. They know the saying. Most people know the saying, excuse me, buy low and sell high. But few have the stomach to do it. Another point he makes is, in general, it's best to avoid stocks which don't pay a dividend, don't have long-term enough track record, background, or involved in technologies or businesses you don't understand. It's also important to know that an excellent company can be an unattractive investment if its stock price is inflated relative to its value based on future earnings. Over time, however, the price of the stock will come back in line. So that's important also. Can't be overvalued. The Monk Group gives a brief letter of recommendation to the Meister plan, and they write that in the 38 years of investing, they noticed that many people think that quick profits can be made in risky and speculative investments. It's not so. Investments or finance, many studies have proven that the best long-term approach to consistently making money and quote beating the market was found to be long-term conservative buy and hold strategies. Patience and discipline are needed to get the emotions out. We see how it's possible to never lose money. We have to have a long-term focus over time by investing in a simple index fund, which we're going to discuss below, is basically the 500 top companies of the S&P 500. We will not lose out. On the contrary, we're going to gain. Another interesting analogy that could be used, Naftali Horowitz once said this, a financial investor. Weather forecasters are statistically more accurate the closer the time period they're forecasting for. Investing is the opposite. The longer the time period is, the more accurate the forecast is. I want to just end with sharing a personal story about myself that ties into this with Bitcoin. We're going to have a whole session on Bitcoin later on. Bitcoin right now is currently $108,000 a coin. Just a few days ago was the all-time high, $112,000 a coin. One of my old chavrusas, an older individual who knows a lot about finance, not very, very old, but older than me for sure. He introduced me to Bitcoin and told me what it was, answered my questions, and explained it to me. Already 4 years ago. I can't believe it's been that long. More than 4 years ago. It was because I know I have the graph in front of me. Must have been around April 2021. Now we're almost in June 2025. At the time, I already knew about finance a little bit, fair amount. Now I know obviously a lot more 4 years later. Did a lot of research around 3, 4 years ago and made a mistake. I bought a lot of Bitcoin in one shot. I don't know if we already discussed or we will discuss dollar cost averaging. That's when I learned by example what dollar cost averaging is. I'm bringing up the point to make out the point of dollar cost averaging rather to bring up the point about long-term investing and dollar cost averaging. But the main point is for long-term investing, and here's the point that I'm trying to make. Shortly after we made a big investment in Bitcoin, it was pretty much in the 60,000 range a coin. Uh, Peaked, I think it was around 67,000, around there. You can't even see it on a graph because it was for such a short period of time, the peak. So when you zoom out on a graph for 5 years, you can't really see it. Can't see it. Anyhow, anyways, so the thing peaked shortly thereafter. You know the story, it went down to around 35,000, losing half of its value of everything that we put in. This was, in my life, the biggest financial loss that I personally, or that we personally experienced ever with anything. This is the first time to have a significant amount, and that was lost. That was put in. At the time, I understood the technology of Bitcoin. I mean, not completely. It's a very complex technology and an amazing invention. But nevertheless, I understood it. I believed in it, and I didn't sell 1 cent worth. What happened after was so that was when you click on a Bitcoin graph, that was around April 2021, and it went down tremendously until July, and then it went back up again. November 13th, 2021, it went back up to 64,000 again. Everything went back up. But then something happened. It went down again. And it went down not just to 35,000. It went down to almost even 15,000. Can you imagine that? Everything that was put in for every $100, it was only worth $25. Can you imagine? And it was like that for years. Years. In fact, it didn't go back up to the 60,000 area until April of 2024. But I didn't panic because I understood the technology and I believed in it. And because of that, I didn't lose a dime. And not only did I not lose a dime, but now I'm sitting here a year after April 24th when Bitcoin is at an all-time high. June 2025, 110,000. So now I've been putting money in every single week for 4 years. Not as much as that in initial investment, for sure. Much less. But we've been putting money in, and now we're up. That's what long-term investing is about. It's about making a strategy. And that's when I learned the concept of dollar cost averaging, which means you don't want to dump all of your money in at once. Because if you put all of your money in at once and then it goes down, now you can't buy anything because you already put all your money in. And now your gains aren't going to be as much as they could have. So you got to do it slowly over time. That's the importance of dollar cost averaging. Anyways, that's the lesson today. It's about the long term. In the long term, things will be very good. That's how it's possible to never lose money. It's possible to never lose money when you do your homework, you do your research, and you invest in something that you have very strong feelings will go up, and you did research on it. You invest in the top 500 companies of America. Look at what America has done over the last couple hundred years. We're assuming things will continue the way they are. Companies will keep making money and will get better and will grow. When you invest in an index fund, you're investing for the long term. You therefore know that it's going to go up in the long term. And therefore, it doesn't matter that the stock market is temporarily going down. Zoom out. It's going down a year or two, three. Very few people are able to look at the bigger picture in life. They tend to look at the small picture. Zoom out. It's not about a 100-yard sprint. It's about a marathon. Zoom out in life. Think about what's going to happen. Don't just think about a year, two, three. Think about down the line. That's how you're going to be a successful investor. See you in the next one. Like and subscribe if you haven't already.